We are trading near the 265 level on US 10 years. Does that make any difference to you? The technicians are going to get kind of excited about this line in the sand. Does it excite you?
Is it there already?
I think we're kind of nearly there.
If only it was so easy to make money that way, you could just look at a chart and break a point and it just carries on. It's probably a buying level. I know that isn't very fashionable, but we thought that yields would peak in Q1. Obviously, there's momentum for the yields to keep going up here, but this is a buying opportunity, and I'm looking at it on a sort of 3 to 6 month view. I would sooner be buying than selling at this level. Now, to actually think that yields go higher and we could get towards 3% and even higher, you've got to have a very clear view on inflation. And you need to know something that I don't know about the dynamics behind inflation and why it's where it is. You're basically going to have to call higher inflation and a Fed that's going to go past the 2.75 number that it says it's going to. And so far, they've been true to their word. So they're sticking with the idea that the median long-term dot, so that's in 5 years' time, where the money rate would be, 275. So to be bearish, you're calling something that the Fed's not telling you and isn't evident in the inflation world that I'm looking at. So we're not ready to tear up and reverse all of the views we've had in the last 5 years that call into question the dynamics behind this inflation idea that people seem to have. There's a reason for low inflation. Demographics, technology, you've got all the AI, robotic stuff, all the reasons that we discuss regularly, they haven't suddenly gone away because we've started a new year. As far as I'm concerned, I'll do the opposite of the bearish people here.
First of all, Stephen, I've got the dots up here, and if you look at this chart, you can see the 275 level that you just referenced. That's where the Fed, basically, its best guess at where it's going to end 2019. I talked recently to Jan.19 of Goldman Sachs and a number of other strategists there, and they seem to all take it as a given that this year there will be 4 rate hikes rather than 3 because inflation will be faster than expected. Why do you doubt that?
I don't see how you could possibly know that there'll be 4 rate hikes. I mean, basically, each one is path dependent. It's state contingent. Depends on what's happening at the time. I can imagine there'll be another 1 or 2, and then we get to 2% on the IOER rate, and we'll see what the behavior of asset manager is when you get to 2% yield on risk-free, short-dated assets. Nobody knows. Nobody knows what's going to happen to inflation. Stuff happens, and the best laid plans often don't actually come to fruition. So I suspect that that idea of 4 hikes without interruption is vulnerable at some stage this year. It's a very difficult thing to call. The Fed's trying to get rates up for whatever reason. It could be as simple as the fact that they need something to cut when we have the next downturn. And by definition, the next downturn is getting closer and closer because each year that goes by definition, we're closer to the next recession.